I would now like to introduce today's moderator, Bill Black.
Welcome to Fridays with Vistage. My name is Bill Black, and I'm a Vistage member and speaker, and your moderator for today's webinar entitled, What Factors Maximize Business Value? Ask yourself, what would encourage a buyer to pay the maximum value for my business? Does my business have a single value to all buyers? Are there times when a business is more or less valuable? Is selling to someone in my industry the right move? In part 2 of our series on maximizing your business value, presenter Michael J. Querard will offer expert advice you can use whether you're planning to sell now or in 10 years. Michael is a senior mergers and acquisition advisor at Generational Group. He has worked with both smaller private and Fortune 500 public companies, with both domestic and foreign firms, and with both strategic and financial buyers. For the last 15 years, he has focused exclusively on the middle market, working with business owners and investors to maximize the value of their deals. Michael, the floor is yours.
Thanks very much, Bill. Welcome, everybody. So we're talking about the factors that maximize business value, and if we're going to talk about value, let's first define it. This is the textbook definition of value: what a willing and informed buyer will pay a willing and informed seller, neither of whom is under any duress. What this means is that your company's market value will really be determined by buyers in the market. Our challenge then becomes, number one, finding buyers that are willing to pay a premium to acquire the business. Number two, identifying a buyer's motivation for acquiring the business. And number three, incentivizing those buyers in some way to pay a premium by delivering the proper messaging. Now, why do buyers buy companies? It depends a little bit on who the buyer is, which leads us to our first poll question. Have you been approached by buyers? What type? And you can check multiple answers. Your choices are competitors, employees, family members, corporate buyers, or private equity groups. So I'll give you a second to put in an answer. Looks like most of the attendees have got an answer in. So let's see what the poll shows us. So look at that. The vast majority of people have either been approached by equity groups or by competitors. And competitors is really one of the most common groups of buyers to approach business owners like us. Equity groups have become much more active in the marketplace. The overriding objective of any buyer is to actually make money on the acquisition. That just makes sense. Some of the motivations that buyers have are shown on the next page. These are some of the primary motivations or ways that they can accomplish the goal of making money on the acquisition. For example, number one, as many of you who may have attended the last webinar heard, you must understand your own value or buyers are going to take advantage of you. That's the easiest way to make money on a transaction. If you look down at motivation number 5, offsetting seasonal or cyclical fluctuations. One of the best stories I've ever heard here is a company in California that manufactured charcoal briquettes. You may have heard of them. Kingsford actually purchased the company that manufactured Duraflame fake logs to give themselves a product that they could sell both in the wintertime and in the summertime. Skip over to number 11. Acquiring outstanding management or technical personnel means that the buyer is acquiring intangible assets, and that is a huge part of your possible value. Number 12, opening new markets for present products or services. That's a geographic expansion, and it's usually best accomplished by buying an existing entity in a new territory. What kinds of businesses do buyers target? You might be surprised to find out that your business, the small privately held companies, is the most sought after and the most acquired kind of business in North America. A study that was done by the Boston Consulting Group and the Leipzig Graduate School of Management found that serial buyers, companies that go out and buy company after business after company, are looking for smaller privately owned businesses. According to the study, the more small privately held companies these serial acquirers purchase, the higher the serial acquirer's returns. In other words, the more smaller private companies these businesses buy, the more money they make. Why? Well, in the words of Jack Welch, it is faster, easier, cheaper, and smarter for me to buy you than it is for me to build you. And if you think about that philosophy, reflect on your own experience, and I'm sure that you'll agree that he is right. So you as a private business owner have the most sought after kind of company, and you are also the most frequently acquired kind of business. If you look at the different segments here, there are big, huge public deals that are done, companies with revenues over $500 million. I'm not even including those in those numbers because compared to the number of deals that are done in what we refer to as the middle market or lower middle market, there's not a lot of that going on. Lower middle market companies, revenues under 50 million. Last year, according to Capital IQ, which is a database administered by the Standard & Poor's Corporation, were 60% of the deals that were done. So this is where the action is. Why are big companies, why are public companies, why are foreign and domestic companies buying businesses like yours? Again, to make money with them in the future. As you may have heard in the previous webinar, buyers are not buying your past performance. Instead, they're buying a credible, documented future. They're focused on how they can make more money with your business in the future, a future where the buyer's financial, human, and other resources are brought to bear on growing what used to be your business. Now, done properly, an owner's exit can result in that owner getting paid for the future without the risk or cost of achieving that future. For this to occur, a business owner must not only look inwardly at him or herself and the business, but that owner must also look externally at current market conditions, at timing issues, which leads us to our second poll question. When do you think you will sell your business? And I'd like you to just select one of those choices, either in the next 3 years, 4 to 6 years out, 7 to 10 years out, or you think you're never going to sell your business. I'll give you a second to select one of those. Looks like most people have made a selection, so let's see what you're thinking. So it seems pretty fairly split, with about 40% thinking they're going to sell in the next 3 years, 4 to 6 thinking they're going to sell, 33% thinking they're going to sell in 4 to 6, and the balance thinking they're going to sell 7 to 10 years out. Interestingly, everybody on the webinar is believing that they are going to sell their business at some point, which makes sense because one of the undeniable truths of owning a business is that someday, some way, every one of us will exit our business. What this poll and this timing means is that this is really the essential ingredient for maximizing value, and it's also the most crucial, most overlooked part of the plan. What we're talking about here are cycles in the mergers and acquisitions market. You all are familiar with cycles. You start at a bottom, you go through a period of expansion, you hit a peak, then you go through a period of contraction, and you hit a trough. And so cycles work on a reliable, repeatable basis. Expansion, peak, contraction, trough, expansion, peak, contraction, trough. We have cycles in the mergers and acquisitions market, just as you may have cycles in your own industry, in your own state, and obviously in the national economy. The basic relationship in cycles is the supply-demand relationship. When we're talking about supply and demand in the M&A market, the supply is the number of companies that are available for sale, and the demand is typically the amount of dollars, the number of dollars that are looking to invest in those businesses. Obviously, if you have a much higher demand and a much lower supply, then pricing is going to go up. Conversely, if you have a much higher supply and a much lower demand, pricing is going to go down. These conditions are typically called either a seller's market or a buyer's market, respectively. The reason you as a business owner would want to sell in a seller's market is that you'll usually get a much better price for the exact same business. And that's really important to note. You don't need to increase your revenues, you don't need to increase your profit margins or change your headcounts or the industries you serve in order to get a better price. You simply need to be aware of these external forces and those forces' effect on the marketplace. And this has been true for over 120 years. If you look at this chart, you can see way back in the late 1800s, there's our first ever recorded wave of M&A activity. And ironically, this was known as the Great Merger Wave. These were mostly horizontal mergers creating very large monopolies. And this wave really was ended by a collapse of capital markets in the early 1900s. We didn't have another wave of M&A activity until the Roaring 20s. These were mostly vertical mergers, creating oligopolies, not monopolies. And it was really brought to an abrupt end by the 1929 stock market crash, which was the first major event in the Great Depression. Then you'll notice we didn't really have another wave of M&A activity until the late 60s. These were mostly conglomerate mergers, ended by an oil shock that sent the world into the world economy into a recession. We then waited for the Reagan-led years, a smaller wave, but very important because this is really where LBOs, leveraged buyouts, first became common. Up to this point in time, buyers were buying businesses with cash, with stock. During the Reagan-led years, they started to buy businesses with debt. This wave ended by the stock market crash of October 1987. Next wave, you can see, started in 1993, peaked out in the year 2000. Again, leveraged buyouts remained very common. This was ended by a combination of the dot-com bubble bursting in 2000 and the 9/11 attacks in 2001. Then we had another wave of activity that really peaked out in 2008, another primarily financial wave. LBOs increasing dramatically. It really actually contributed to the financial crisis worsening when the housing bubble burst in 2008. Then from about 2014 to now, we have the current wave of M&A activity. Based upon the data that we were able to look at over the last 12 to 18 months, the last 18 months have been one of the best sellers markets for small privately held companies in the history of mergers and acquisitions. So let's talk about some of the factors that have been the primary influencers of market cycles over time. First, interest rates. You should know that interest rates have a direct, inverse, and sometimes disproportionate impact on the values of privately held businesses. This means that as interest rates go down, values of businesses go up. Part of this is the cost of funds. When interest rates are low, buyers can borrow more money and still pay the same monthly interest payments, giving buyers more funds with which to pay for acquisitions. Conversely, as interest rates go up, the value of your business goes down. Investors are constantly identifying opportunities and comparing them with the risk-free rate of return, which is embodied by the U.S. 10-year Treasury note. As the yield on the 10-year Treasury note goes up, investors' desired return on their other investments, what they refer to as their so-called hurdle rate, also increases. As the hurdle rate goes higher, the price investors are willing to pay goes lower. You might ask, where's the 10-year Treasury been? For most of the past 10 years, rates have been low, historically low. So values of businesses have been, as expected, historically high. Recent articles have noted that prices paid for middle market companies have actually never been higher. Now, part of the reason for this is that as investors look at these rates, they're trying to assess what kinds of returns they would expect from an investment in a business like yours. So if we look at where the 10-year Treasury is currently trading at about 2.5% return, that would be my risk-free return if I was an investor. Let's say that you have a company that's generating $300,000 last year of profits, free cash flow. Your business, while being very good, is not risk-free. So as an investor, I would want to find a higher return out of your business. I would want to build in what is called a risk premium. Let's very simply estimate that my risk premium would be 4 times what I can get risk-free. That means that my hurdle rate would be 10%. That would be the desired return from investing in your business, and that would lead me to a maximum financial business value of $3 million. In other words, if I pay you $3 million and I generate a $300,000 return next year, I do as well as you did, I will hit my hurdle rate. If I pay you less than $3 million, I will probably exceed my hurdle rate. And if I do better than you did last year, which is my expectation, I will also exceed my hurdle rate. Now, let's say that you decide to sell 2-3 years down the road. all indications are that the Federal Reserve would like to raise interest rates up to about 3.5%. That's the neutral rate, where the interest rate does not positively nor negatively impact the economy. Currently, the rate's between 2.25 and 2.5, so we're looking at 4 to 5 different interest rate increases if they're going to continue to step them up in quarter point or 25 basis point increments. So let's go a couple of years out. Let's say that interest rates have gone up by a point. So now the risk-free rate of return is generating, I can get a risk-free rate of return at 3.5%. Let's say that your company is still very profitable. I realize that's an assumption, but it's one I think I'm safe making. So your company's generating $300,000 of profits. My risk premium doesn't change. I still want 4 times my risk-free rate of return. What does change then is my desired hurdle rate. And what that's going to affect is the amount that I, as an investor, am willing to pay you for your business. So notice, a 1% increase in rates has led to a decrease of over $850,000 in your business's value. So as I mentioned earlier, interest rates have a direct, inverse, and sometimes very disproportionate impact on the sale of businesses. Let's look at some of the other factors that influence the M&A market cycle. Inflation is important. It's currently low, which is fine. If, more like when inflation increases, the Federal Reserve will be even more pressed to raise interest rates. Interest rates currently, the Federal Reserve has stated that they are pausing any additional increases in interest rates, probably for the rest of 2019, and then they're going to reevaluate where the economy sits in 2020. Again, if inflation starts to rise, they may be pressed to increase interest rates even more quickly. And as we've just discovered, higher rates lead to lower company values. Tax rates are also very relevant because they impact how much you keep when you sell your business. Right now, taxes are lower for most business owners. The corporate tax that affects C corporations have been lowered 40%, from 35% total to 21% total. And owners of qualifying pass-through entities, certain S corps or limited liability company LLCs, can exclude up to 20% of their profits from any taxes. So if you structure your deal as an asset sale, you're going to end up paying a little bit more in taxes. If you structure your deal as a stock sale, you get much better tax treatment. The money that you would get for selling your business is actually going to get taxed as long-term capital gains, and that rate is just 20%. You can see it was lower at 15% during the end of President Bush and the beginning of President Obama's administration. Then it reverted back to its 20% level, which is significantly lower than what it has been in the past. And there's a lot of discussion on Capitol Hill about raising capital gains rates. Let's talk about demographics. The most impactful demographic group that we have seen in our country in the last 60 years are the baby boomers. Baby boomers are everybody born between 1946 and 1964. What happened? The World War II ended, everybody came home, everybody was happy to see each other. You got a lot of babies getting born. And the impact of those baby boomers on our economy in different segments has been staggering. Go back and look at the revenue and profitability of businesses in the baby products industries, companies that were manufacturing diapers or formula or baby furniture. Their revenue and profitability increased dramatically during the late 40s. In the early 50s, mid 50s, companies that were building public schools saw their revenue and profitability increase dramatically. In terms of a generation, baby boomers are one of the most entrepreneurial one of the most entrepreneurial generations that we've ever seen in our country. The U.S. Census Bureau estimates that 70% of the businesses in North America with more than one person on a payroll are actually owned by baby boomers, which is a staggering statistic. 7 out of 10 businesses in this country that have more than one person on the payroll are owned by baby boomers. What's going to happen when those baby boomers decide that they want to exit? And why is that relevant on the market cycle? Well, it's going to affect the supply. The Family Business Institute estimates that there's about $10 trillion in dollars sitting in the hands of baby boomer business owners. If even half of those business owners decide that they want to go to market over the next 4 or 5 years, that's going to significantly impact our market because of the tremendous supply that's being added. Where are we in the economic cycle? If you look at the way the U.S. economy has been growing between 2.5% to 3.5%, everything looks really good. The economists that are concerned about the future are really worried about the fact that we are now in the longest economic expansion we've ever experienced in our history. And if you've been expanding this long, that means that you must be closer to the end. So being aware of where we are in the economic cycle, how business owners feel about the economic cycle. There was a recent study that Vistage commissioned of business owners like yourselves that found that small business owners' confidence in the economy has recently fallen to its lowest level since President Trump was elected. What kinds of things are business owners worried about? Things like trade, things like tariffs, things like the impact of those on the economy. The fact that almost, according to CoreLogic, almost half of the real estate market is currently overvalued. All of these things bear on the economic cycle. All of these things bear on both your industry and the M&A market. Foreign buyers have been incredibly involved in the U.S. market. The importance of the U.S. market in the minds of foreign buyers is significant because they want to ensure that they have access to one of the world's largest consumer markets. And the current administration's policies are telling foreign companies, if you want to ensure that you have access to the U.S. consumer with no tariffs, no restrictions, then you either have to be a U.S. company or you have to have a presence on U.S. soil. And again, to quote Jack Welch yet one more time, it is faster, easier, cheaper, and smarter for them to buy you than it is for them to try to build you. Leading international acquirers of US-based companies actually came from Canada. That was by far the largest purchaser of US-based companies, accounting for 35% of the deals done last year. Europe accounted for 40% of the deals done. And of those 40 points, about 15 points of it was the UK. The UK is incredibly concerned about the Brexit negotiations. There are actually UK companies that are finding that it is less expensive for them to produce a product in the UK, ship it to North America across the Atlantic, ship it back across the Atlantic to the European continent, that is less expensive than merely shipping that product across the English Channel and then paying the tariffs that are associated with that. So international acquirers very active in the US marketplace. Foreign exchange rates were one of the key factors that lifted the M&A market after the Great Recession. All of these factors influence the mergers and acquisitions market. The most important thing for you to remember is that all of these factors are completely beyond your control, and yet they can have a huge effect on your company's value. What does all of this mean? You have to recognize the external factors that influence the market. You have to assess whether you're in the right kind of market, and then you have to decide to test the market to get the highest possible value. Keep in mind where we started. Your company's value is going to be determined by buyers in the marketplace. Going to market at the right time, when you have more leverage as a seller, is going to influence the prices that buyers are able to pay you and drive your value up. Of course, how you do this is also important. In last month's webinar, Dave Heyman gave you all an overview of the process that M&A professionals use. I want to give you some more detail on exactly how to get buyers to pay more for your business. But before I do that, I want to run through our last poll question. How much of your personal net worth would you estimate is tied up in your business? And again, you can select one of these. You can estimate that your business is worth less than 20% of your personal net worth, 20 to 50%, 50 to 80, over 90, or if you simply don't know, select that radio button. I'll give you all a second to put in a selection. And it looks like most of the folks have actually answered this question. So let's see what the poll shows. So you can see the majority of people believe that their value, that their personal net worth is anywhere from 20 to 50% or 50 to 80% is tied up in their business. Studies show that for the typical business owner, it's typically 70% or more of their net worth are tied up in their private company ownership. In fact, a study done by the Federal Reserve stated that over 70% of the typical business owner's net worth is, and I love the way that they put this, in an illiquid private company investment. And the reason that's important to understand that way is this is an investment. In addition to being your livelihood, in addition to being your passion, in addition to being your avocation, this is an investment. And for most of you, selling your business will be the single most impactful financial event of your life. Moving on from that, once you understand the market issues, you're then able to go through the process the right way. So I want to spend the next few minutes walking you through a more in-depth presentation of the professional mergers and acquisitions process. Now, when I start this, let me tell you, number one, that this process, this is the same process that would be used by any M&A firm, any investment bank for any client. If you are a multi-billion-dollar company and you wanted to hire Goldman Sachs or JP Morgan Chase or Bank of America Securities, the process we're going to run through right now is exactly what they would run for you. If you work with a smaller investment bank or a bank that focuses, like Generational Group does, on the lower middle market and middle market segments, this is the process that a group like Generational runs for you. It dates back to the Rothschilds, who are considered the world's first investment bankers. They developed this process about 100 years ago. It hasn't changed significantly in that time, mostly because it works. It works on a predictable, reliable basis. You can see the multiple steps that you have to go through in the professional process in order to be able to extract a maximum value deal. So let me just walk you through the different phases of this process. This process really has three major phases. In the first phase, what we refer to as the planning phase, buyers don't even know that you're on the market. During this phase, you're producing documents, things like an evaluation that enables you to assess your company's strengths, its weaknesses, its opportunities for growth. You need to be able to assess your company's enterprise value, the financial value of your business as an ongoing enterprise. Many times, if you recall from the first webinar, that value is going to be calculated as a discounted cash flow analysis. In other words, the profits that your company is expected to kick off from now until the end of time, discounted back into today's dollars, the sum of that is the enterprise value of your business. Another document that needs to be prepared is what is referred to as a confidential information memorandum, or more commonly referred to as the book or the deal book. This is a sales and marketing document that's going to go out to buyers at the right time so that they can find out everything that they need to about your business. Now, one of the mistakes that business owners sometimes make when they send that deal book, that information memorandum out to buyers, is that they put a price in there. Most investment banks will not put a price on your business when they go out to market, because we realize that in negotiating, whoever speaks price first loses. So if the seller puts a price out there, what that seller has created is a ceiling on the negotiations, and the numbers will go down from there. If you can incentivize the buyers to make a first offer, you've created a floor, and pricing will go up from there. So you produce these documents, use the information in these documents to begin to execute on your exit plan. When should you have your exit plan in place? My advice to you is to have it in place as soon as possible. The nice thing about having a plan in place is that you can execute on that plan whenever the timing is right for you, whenever it's right personally, or let's say something unfortunate occurs and you have to exit your business. Well, if you have a plan in place, that exit will go much more smoothly, much more predictably, and will typically have a better financial outcome. If the decision is made to go to market, you enter into the next phase in the professional process, which is the marketing phase. One of the big differences between the way investment banks or M&A firms market businesses and the way business owners market their own businesses is that the investment banking, this professional M&A process, is very proactive. It's not reactive. You can't just put a for sale sign up in the front window of your business and expect that premium buyers are going to come in and pay top dollar for your company. So first, we develop a list of buyer prospects. We'll talk more in the next couple of sessions about who these buyer prospects should be, but you're going to develop a list of probably anywhere from 200 to 300 potential buyers for your business. And I realize that number may shock some of you. I've had feedback from business owners that can't believe that those many business owners or those many business buyers exist. But keep in mind, if you just took one database, the Capital IQ database, that one computer database administered and run by the Standard & Poor's Corporation contains almost 40,000 entities around the world. Generational maintains its own worldwide database that has almost 34,000 registered qualified buyers in that database. And keep in mind, those buyers not only get to register, but they must qualify. The most important qualification a buyer has to demonstrate, you guessed it, they've got to be able to pay for your business. Why spend your time talking to someone who can't afford to pay for you? So this list of buyer prospects will be developed. You wouldn't send the confidential information memorandum out to all of these buyers because then you're going to be challenged in maintaining confidentiality. We're paranoid in the world of mergers and acquisitions about confidentiality, and you need to be as well. A study that was done by the Cass Business School in London, England, looked at over 350,000 closed and proposed merger and acquisition transactions, so a huge sample size. They found that in the majority of cases where there was a breach, where there was a leak of information, those deals did not close. And the ones that did close, prices were negatively affected, and the time necessary to increase the time necessary to close the deal increased by about 70%. So the data tells us that if we don't maintain confidentiality, we're endangering the deal. If it does close, you're going to get paid less and it's going to take longer, none of which helps you maximize your value. So what's sent to the buyer prospects are profiles, often referred to in the industry as teasers. These are 1, maybe 2-page documents that talk about your business in such a way that a buyer who would be interested in buying your business would go to the next step, sign a non-disclosure agreement, and then receive the information memorandum. Only those buyers that actually signed the non-disclosure agreement would get the information memorandum. Those buyers that are interested in visiting you may request that. There are some advantages to allowing buyers to visit earlier. There are some significant disadvantages as well. Again, you're trying to maintain confidentiality, you're trying to control the process. Having multiple guys in suits, and it is about 99% male, having those visitors walk through your facility, at some point employees are going to wonder what's going on, and you're going to need to tell them. And the reality is that buyers understand that. Buyers are actually trying to unsettle your employees. I know that sounds unkind, but from a buyer's perspective, if I can unsettle your employees, if I can increase the risk that some of those key employees may look for jobs elsewhere, then by increasing the perceived risk, I am decreasing the implied value. So talk to advisors about how to handle requests for buyer visits. It's fine to have buyers visit at the right time in the right way. You just might not want to have them do it too early. The next step in the marketing process then is the limited auction. Now, this is probably the single most important step that we go through when taking a company through the professional process. In a limited auction, your business is actually being shown to multiple buyers simultaneously. You are negotiating with multiple buyers simultaneously. The reason for that is to create leverage. If you recall, our initial definition of value said it was what a willing and informed buyer will pay a willing and informed seller, neither of whom is under any duress. Duress is a technical legal term that means that somebody very close to you is under threat of imminent financial or physical threat. That's not what we're talking about in a traditional buy-seller relationship, but we are talking about leverage. Whoever has more leverage in this relationship is going to come out of the negotiation ahead. If you look at the way this is typically done, you can begin to think about which of these parties, the buyer or the seller, has more leverage. In a traditional one, it's typically the buyer. The seller's leverage here is, I don't want to sell to that particular buyer. But other than that, the seller really doesn't have any leverage, and they certainly have no choice. Contrast this situation, which is what most business owners commonly go through, with what we refer to as the limited auction structure. In a limited auction structure where you're the seller, you're negotiating with multiple buyers simultaneously. That gives you the ability to create competition. Competition will lead to a higher price. The way this usually is done is a call for offers is sent out. The buyers send in whatever price they're willing to pay for your business. And then you can sit back and look at those different offers and decide which one really is the right fit for you. When we talk about maximizing value, sometimes it's the biggest number. Sometimes that's the maximum value deal. But let me give you another couple of possibilities, and you can consider them and determine whether they might fit you better. Maximum value might also mean a deal where you're receiving a little bit less on terms of the top end, but because of the structure of the deal, you're going to keep more money in your pocket. That may be a maximum value deal. You may choose to sell to a buyer that is going to do a better job of maintaining and extending the relationships that you've created with your employees, your customers, your vendors. That may be a maximum value deal to you. One of the beauties of using the limited auction structure is you get to pick which of those definitions you like best and which deal most closely approximates that maximum value to you. Second advantage of the auction structure, and this one's a little bit less obvious, is that by talking to all of these buyers simultaneously, you can select which buyer is the right fit for you. It may be the buyer that's offering you the most money. It might also be a buyer that's interested in partnering with you, providing additional resources to grow the business, and then going for a second kind of liquidity event at some point in the future. That might be the right buyer. If you're working one buyer at a time under the traditional approach, you don't really have any choice. By using the auction approach, you have multiple choices. Third advantage of the auction structure, it really does allow you to push the buyer that you want to work with through the due diligence process and out the other side and get the deal done. By having backup offers, you now have some leverage over the buyer that you've chosen to work with, whose offer you like best. You now have leverage to get them through the due diligence process and get the deal closed. So the limited auction structure, incredibly important, a key part of the professional process. You then begin to negotiate the transaction. You'll find that this is one of the more time-consuming steps in the process, actually negotiating. In fact, often when we're working with private business owners who are acting as their own deal makers, the recommendation is that they go ahead and hire someone to handle the negotiation for them so that the business owner is able to focus on running the business. If you think about the value that exists in your business, it is in the future. If you can demonstrate that value to buyers by consistently hitting your projections, you're going to put yourself in a much better position to get a maximum value deal. What typically will happen is that you will start with a couple of hundred buyers. You might have 40 or 50, maybe 60 that will sign non-disclosure agreements and return them to you. Those are the buyers, again, that will receive the confidential information memorandum. By the time you get down to the letter of intent phase, you may have 3, 4, 5, as many as 8 buyers that have submitted this paperwork to you. A letter of intent is a simple explanation of the terms and conditions upon which the buyer is going to buy your business. You can receive multiple letters of intent. They are non-binding, so you can sign it, and as long as there's no clauses written into that document that would penalize you for exiting the transaction, you can exit the transaction with no penalties whatsoever. Once you decide which buyer you're going to work with, you would countersign that buyer's letter of intent. That's now a dual signed LOI, and it would enable that buyer to begin their due diligence. Now you'll notice that due diligence is pretty close to the end of the process. So from a business owner's perspective, you really want due diligence to go quickly, and you want it to be a period of confirmation, because due diligence is the last thing that you as a business owner have to do in order to get paid. From a buyer's perspective, due diligence is the last thing the buyer gets to do before they have to pay you, which means buyers really want this process of due diligence to take longer. They want to be able to find things that are different. They want this to be a period of discovery, not a period of confirmation. And what you'll find is that every time the buyer finds something different, they're going to come back to you, the business owner, and change the terms, change the structure, change the nature of the transaction. Inevitably, those changes will be in the direction of the buyer. What you can do to maximize value is to have all your information in front of the buyer as quickly and as soon as possible. Make sure that you're telling them the truth and the whole truth, so that when you get to this due diligence process, things move smoothly. The other thing you can do, make sure you go through the auction structure so that you have multiple offers. You have other buyers that you can use as a backup offer if the buyer that you've chosen to work with starts to drag their heels. That buyer will draft what is referred to as the definitive purchase agreement, or DPA. Unlike a letter of intent, the definitive purchase agreement is a binding document. So once you sign that definitive purchase agreement, you have committed to selling your business on the terms and conditions of that agreement to that buyer. If you don't, you can be sued for damages. You can be sued for specific performance. The buyer has some rights in terms of enforcing that. This document is really a risk shifting document. It is frequently advisable to engage at this point in time with a mergers and acquisitions attorney, so that that attorney can review the information, make sure that you're not agreeing to anything that is an unknown or almost or unacceptable legal liability. That definitive purchase agreement, once it's passed everybody's review, is signed at a deal closing, and then payment is made. Now notice that this is two separate steps in the M&A process. The deal closing is where all the paperwork is signed, but the deal's not really done until the money has been transferred from the buyer to the seller's account. So you can pop the champagne at the deal closing, but the real party happens when the money hits your account. That's an overview of the professional process that is used by investment bankers, by M&A firms, to really help business owners extract maximum value for their businesses. So at this point, I think, Bill, if there's any questions out there that any of the attendees have, I'd love to try to be able to address them.
Terrific. Great job. Yeah, we have several questions. Let's start with this one. How does employee engagement relate to maximization of business value and growth?
That's a great question, because that question, that whoever asked that question realizes the importance of your employees, not just to you as a business owner, but to the buyer. The reason that it is faster, easier, cheaper, and smarter to buy an existing business than to build one from scratch is that when I buy that business, I get the entire infrastructure. I get the employees. So if your employees are engaged, that is one of the most important things to be able to demonstrate to a buyer. There was a recent study done by PricewaterhouseCoopers. They asked a number of acquirers, why did they buy businesses in 2018? 2/3 of the respondents said they were acquiring talent. If you think about the unemployment situation and how low the unemployment rate here is in the United States, in certain industries, for example, the transportation industry, the single biggest challenge that a trucking company has is finding, training, retaining good qualified drivers. Now, I'll just add one other thing, if that's okay. most employees get really concerned when they hear that the business is for sale, because the employees think that their job is going to be at risk. What most employees don't realize is that the data shows exactly the opposite. If you looked at 1,000 transactions that were done with optimal or premium buyers, only about 3 out of 1,000 does the buyer come in and fire everybody after the transaction is closed. And again, the reason for that is your employees are a significant intangible asset. They have experience, they have relationships, they're part of what the buyer is buying. So keeping them highly engaged will reduce risk, will increase your company's value.
Great point. It's often been said that a company's best assets go home every night, correct?
Absolutely.
So here's another question for you. What are some of the do's and don'ts that I should know before talking to a potential buyer on the phone for the first time?
Well, again, the buyer's first objective is to try to get the business owner to put some kind of parameters around the financial value of the business. So the buyer typically is going to ask the business owner, what do you want for your business? In our experience, giving any kind of a number, even if you think you're inflating it to a ridiculous level, is a bad move, because you have no idea what that buyer might be willing to pay for your business. The best possible answer would be, what's this business worth to you? Now, keep in mind, when you say that to a buyer that's looking to buy a business at a bargain, that buyer is going to get annoyed. It's not an answer that's going to make them happy. They want a number, and they'll press the business owner for that number. Business owners really just need to stick to their guns and say, look, the business is worth different amounts to different buyers. I know that. What's it worth to you? And if the buyer doesn't want to play ball, one of the benefits of using the professional process is you've got literally hundreds of buyers that you're talking to. Those other buyers are going to make you offers. So I think the biggest don't is don't get tied down into a particular number, and the buyer will be really sneaky. They'll say things like, well, just give me a ballpark, just give me something, some range that I got to work within, because I've got to take this back to my board of directors and get their approval. Don't fall for it. Stick to your guns. Remind them that the business has got a different value to every buyer that you're talking to. You're talking to multiple buyers.
Great advice. Hey, we hear a lot here at Vistage from economists about the potential financial calamities in the late 2020s. In your opinion, will that create a selling surge in the mid 2020s?
In my opinion, I actually think it's going to happen sooner. If you look at economists, and I have some really good friends who are economists, and they tell me that if you put 4 economists in a room and ask them to answer a question, you will literally get 6 answers. Reason I point that out is these are folks who typically don't agree with each other. There was a recent article in Bloomberg that talked about the fact that 75% of economists that were surveyed think that there's going to be a recession, a downturn in the U.S. economy no later than 2021. What typically happens when the market goes into a recession is everybody gets tired of running their businesses and tries to exit their business. That's going to increase the supply. The aging of the baby boomers is going to increase the supply. Based on everything I'm seeing from a data standpoint, Bill, I really think that you're going to see a downturn from the incredibly strong sellers market probably in the early 20s, not the mid 20s.
Great, thank you. Here's another question. A lot of what determines my value seems outside of my control. What exactly can I do to maximize value?
And that is a great realization as well, because as business owners, as entrepreneurs, we really like to think that we're in control of everything. When I talk to a business owner who has created wealth in their business and they're sitting on a multi-million-dollar net worth, that's a tremendous accomplishment, and it's something to be very proud of. At the same time, it's a tremendous risk, because there's no diversification in most cases in that business owner's portfolio. It would be similar to my suggesting to you that you take all your money, liquidate all your assets, take all of those funds, and go buy one publicly traded stock. You wouldn't do that, because you're violating the prudent person rule of investing, which says that you should never have any more than 20% of your assets in any particular, or 20% of your wealth, I'm sorry, in any particular asset class. So you know, business owners kind of see the lunacy of doing that, and yet most business owners don't recognize that they're probably violating that same rule, but it's just in an illiquid investment. So recognizing that these external factors can have a tremendous amount of impact on your business value is important. What can you do to maintain or enhance your value? Number one, go to market at the right time. Take advantage of a seller's market. Just as you would in a real estate transaction, you look around and say, hey, I could sell my house anytime in the next 3 years. Now's not a good time. I'll come back and sell in a year. Now's a great time. I should go to market now. The unintended consequence of selling your business in a seller's market, perhaps before you might have been ready for it, is that you'll become more wealthy more quickly, which isn't a bad thing. The other thing you can do to maximize value is go back and have an assessment done of the levels of perceived risk in different parts of your business. Is your business have a customer concentration issue? Is your business heavily owner dependent? Is your business relying primarily on repeat or referral customers, and your sales and marketing just isn't up to par, and you're leaving a lot of business on the table for your competitors to pick up? Wherever you can identify increased perceived risk, if you can take steps to minimize or mitigate or even eliminate that risk, you will be driving up your business value. Because again, investors are looking for a return on their investment. If you think of return on investment as the amount that I make divided by the amount that I invest, I can't control how much I make because I haven't bought your business yet, but I sure can control how much I invest. So if I want a higher return as an investor, I'll pay you less. If you want more value as a business owner, find out where those risk factors are, where buyers perceive risk, and try to reduce those areas of risk.
Excellent, thank you. So many business owners employ a strategy of buying businesses so that they can get a better price for their enterprise down the road. So if we put the shoe on the other foot, as a buyer, what should I be looking for?
Oh, you can almost take everything I've told you to do and turn it 180 degrees and do it that way. You would want to find a company where you are the only buyer that's talking to that business. You would want to find, again, businesses are typically being purchased for strategic or synergistic reasons. So if you have a weakness in your product line that you identify as a risk, maybe that risk can actually be addressed by buying a company that has a complementary product or a complementary service, and you can create some synergies there. You do, as a buyer, want to try to minimize the seller's ability to talk to other buyers. So one of the more common strategies for accomplishing this is, as a buyer, include in your offer, your LOI, 3 clauses. You'd want to include what's called the standstill provision. What that means is that if the seller is talking to any other buyers, that seller has to bring those conversations to a standstill. You would want to include, secondly, a no shop provision. That would prevent the seller from taking your offer and going around and trying to get a better offer from other buyers. And you would, in most cases, want to try to include some kind of a breakup fee. Something that would tie the seller to your deal. So in other words, you can exit the business or exit the transaction whenever you want to, Mr. Seller, but in exchange for letting you out, you're going to have to pay me back for my time, and that could be anywhere from 3 to 8% of the deal value.
Great advice, and leads me to the next question, which is, it says I'm a smaller business. I do have an offer from a potential buyer, and they're asking me to sign exactly those 3 things: a standstill, no shop, and breakup fee. What should I do?
My advice is, go find an advisor who can help you around that, because what that buyer is trying to do is put you in what are referred to golden handcuffs. So you are then tied to that deal. I don't want to sound overly melodramatic, Bill, but that's a really dangerous position to be in as a business owner. My advice would be to find, and there are actually studies out there that show that merely introducing an advisor or an intermediary to this kind of situation has very positive results for the business owner. If you've got a buyer that's trying to buy you and you tell them that you're going to go through the professional process, you will have one of three outcomes. Either that buyer will run away from you, which is good for the business owner because that buyer was trying to steal that business. The buyer will agree to participate in the auction and will have to compete with other buyers and pay full market value. Or that buyer may actually say, I understand you're going to go through this auction process. That's what intermediaries do. I'm going to make you the preemptory offer that prevents that. The proverbial, it's too good to pass up. So sometimes merely introducing an intermediary into that relationship has very positive effects for the business owner.
Great information today, Michael Querard. Thank you so much for joining us, and it's been a real pleasure to listen to you. Thank you once again.
No, it was absolutely my pleasure. Thank you, and you guys have a great weekend.
And listeners, we're not done yet. Here's a slide coming up that shows the universe of potential buyers. Now, if you'd like to learn more about which of these groups are likely to pay a premium for your company and which ones will threaten your legacy, we invite you to join us for 2 upcoming Vistage Deal Network webinars. The first is Protecting Your Legacy, Buyers to Avoid When Selling Your Business, on Thursday, May 23rd, 2019, 10:30 a.m. to 11:30 a.m. Pacific Time. And second, Finding the Right Buyer for Your Business. It may not be who you think. Thursday, June 20th, 10:30 a.m. to 11:30 a.m. Pacific Time. Now, for these webinars, registration links will be sent to you by email next week, along with a recording of today's webinar. This is Bill Black on behalf of Vistage Worldwide, thanking you for joining us and wishing you continued success. And this concludes today's webinar.